How do I get a home equity loan? To obtain a home equity loan, the process begins by assessing the equity in your home. Equity is the portion of your home's value that you own outright, which is calculated by subtracting the remaining balance on your mortgage from the current market value of the property. Lenders typically require you to have at least 15 to 20% equity in your home to qualify for a loan. For example, if your home is worth $300,000 and you still owe $200,000 on your mortgage, you have $100,000 in equity. Once you determine how much equity you have, this becomes the basis for how much you can borrow, with most lenders allowing you to borrow up to 80 to 85% of your home's equity. Next, it's important to research different lenders. Banks, credit unions, and online lenders offer home equity loans, and each may have varying interest rates, fees, and repayment terms. Comparing offers will help you find the most favorable terms for your situation. Look at the interest rates, which can either be fixed or variable, and consider any fees, such as application fees, origination fees, or closing costs. The length of the repayment period is also a key factor. Longer terms may result in lower monthly payments but higher total interest costs over time. After choosing a lender, you'll need to gather the required documentation. Lenders typically require proof of income, employment history, and creditworthiness, which means you'll likely need to provide recent pay stubs, W-2 forms, or tax returns. Additionally, lenders will require details about your property, including your current mortgage statement, proof of home insurance, and possibly recent property tax records. Some lenders may also check your debt-to-income ratio, DTI, to ensure you can comfortably manage the additional loan payments alongside your existing debts. Once you have all the necessary paperwork, you can proceed by completing the lender's application. The application process will involve a detailed financial review, and most lenders will require a professional home appraisal to determine the current value of your property. This appraisal helps the lender ensure that the value of your home supports the loan amount you're requesting. During this stage, the lender will also perform a credit check to evaluate your credit score, which can influence the interest rate and terms you're offered. Higher credit scores typically lead to better rates and loan conditions. If your application is approved, the lender will present you with a loan offer. It's essential to thoroughly review the terms of the offer, paying attention to the interest rate, any fees involved, and the repayment schedule. The interest rate can have a significant impact on the overall cost of the loan, so consider whether a fixed rate, which remains the same throughout the loan term, or a variable rate, which can fluctuate, suits your financial situation better. Also, be aware of any prepayment penalties or fees for paying off the loan early, as this could affect your long-term plans. After accepting the loan offer, you'll move into the closing process. During this phase, you'll sign the necessary loan documents and pay any closing costs. Closing costs can include fees for the application, home appraisal, title search, and document preparation, and they generally range from 2 to 5% of the loan amount. Some lenders may allow you to roll these costs into the loan balance, while others may require them to be paid upfront. Once the paperwork is signed and the closing process is complete, the loan funds will be disbursed, usually as a lump sum. At this point, you can use the funds for whatever purpose you've planned, whether it's home renovations, debt consolidation, or other major expenses. Keep in mind that your home is being used as collateral for the loan, so it's crucial to make your payments on time. Failing to make timely payments could result in late fees, damage to your credit score, or, in the worst-case scenario, foreclosure on your home. That's why it's important to ensure the loan fits into your budget and financial plans. By carefully managing your loan and maintaining consistent payments, a home equity loan can be a valuable tool for accessing funds at competitive interest rates.